Okay, Chapter 8, Part 2. Okay, let's get into a couple of accounting things related to cash. One is that you're going to need to create a T account or in your chart of accounts, an account called cash over and short. And what happens is that it's not unnormal that people make mistakes, especially in crowded situations where maybe someone's handling a cash register. And so doesn't mean it's criminal just because they're short or they're over in cash. It could be just human error. And if it's a trifling amount, you're not going to really deal with it other than just record it as an expense. But this is also one way of tracking. Maybe one employee is a certain problem and you need to manage that employee. But generally, it's just accidental. And so you're going to create an account because what happens is you count up your register and you find out that your cash was 555 and then sales was 550. Well, they obviously collected $5 too much. Well, you need to, since this is not in balance, you need to correct that. And sometimes they'll be under or over and so forth. So you're just going to create this account and track it, and hopefully it'll balance out. It never does by the end of the year, but it is an operating expense when handling cash. Cash receipts by mail, very common, especially when you bill your customers and so forth. So one of the things you would do is, preferably you have two people assigned to opening the mail. You'd be surprised how many people still send in cash by mail. Well, with two people counting this and verifying it, it sets up one watching the other. Now, if these two were working together, it would be collusion, but chances are two people will keep each other honest. The cashier deposits money in the bank, and maybe another person is recording this as the record keeper. So you can see there could be some segregation of duty here. Cash disbursements, same thing, is especially important because large theft can occur from payment of fictitious invoice. Case in point, a lot of times companies will get an email bill for let's say toner on for their printers, and what has happened in the past is they'll just get this bill and pay it without really verifying that they in fact order this stuff, and B, was this stuff actually delivered. And so you'll want someone to start monitoring and verifying that A, that we did order this, and this was a valid bill and so forth. So again, you want to have a special person handling this disbursements, and this person needs to be trained. A voucher system of control. So you do want to verify approving and recording obligations for eventual disbursements, and issuing checks. It could be a whole segregation and so forth, and there needs to be a process. So we're not going to just pay every bill just because it was put on our desk. We're going to verify and so forth. So again, and here's a variety of processes. There's a purchase requisition. Someone orders it maybe from the machine shop, and then someone else orders it, and then you have the supplier mailing you the bill. You receive a report from the warehouse that it was actually received. It was approved by approved by accounting to be paid, and then someone else is paying this. So you can see there could be a whole verification process. And all of this might be done by, or should be done by, separate people. Petty cash system of control. So what is petty cash? A small payment required in most companies for such items as postage or repairs and supplies. So think about it. You have your receptionist, he or she, the mailman comes to deliver the mail, and there's one that is 7 cents short on postage, and the mailman wants to collect that 7 cents, or he's going to hold up. What if someone was paying their $1 million bill? Are you really going to hold that up for 7 cents? No, of course course not. So you want to authorize certain people to be able to handle small amounts and be able to maybe make decisions on the fly when they appear. And so you're going to set up and operate what is called a petty cash fund. And so you and the accounting person is going to journalize this, but other people are going to actually manage this process. So how does this happen? Well, a petty cash fund is used only for business expenses. It would be nice if that was really true, but I won't go into all the stories. So how does this happen? So again, they're just showing some how it is misused and so forth, but you want to set up a petty cash fund. So what you're doing is you're taking cash out and then you're giving someone petty cash. So it might be petty cash, a dash, someone's name, and you're establishing it. So you're giving this person discretion over how to spend $75 over a certain period of time. This might be over a month or a week or so forth. And then this person's going to handle various things that come in. For instance, maybe cleaning, came in, tile cleaning, maybe some transportation, or customer's package which is delivered, or flowers were ordered, or coffee was ordered by the sales department. It could be endless. And so this person's going to pay this miscellaneous expenses and keep the receipts. And then at some point they're going to turn these receipts in because they're running out of cash, and you need to replenish that fund. And so now the accountant records these and then replenishes the fund with more money to bring it up to the $75. And sometimes there'll be an over or short position. Move on. There's bigger problems in your business. It's not going to, anyone who's handling cash is susceptible to make mistakes. So, but you notice when you journal this, now when you're replenishing it, you don't really replenish it. You're not replenishing it as to the fund specifically, its name. You're just getting a list of those expenses, and you're just paying those expenses. But where does this money go to? Well, remember, the petty cash person already paid this, so this is going back to this petty cashier to replenish their initial fund. Bank services. Banks provide a variety of services. They have signature cards, maybe bank accounts, and various people have access to those bank accounts, which is verified by signature cards. They keep track of your deposits. They provide third-party bank statements that's used extensively to verify. They can provide electronic funds transfers as well as disbursement of checks and so forth. So there's a variety of services, and we haven't even gotten into loans and so forth. It could be even a foreign currency exchange and so forth. So bank services and bank relationships are very important to businesses. The use of a bank, obviously, the amount of currency that must be kept at hand. You don't want to keep a lot of money on your premises. It's safer in a bank and so forth. And you will get a bank statement. And usually once a month, you have to reconcile these bank statements to make sure that they match your records. And there will naturally be some discrepancies. And then you have to account for those discrepancies every month. It's a painful process, but it does need to be done every month. So what happens at this? So again, this is a bank reconciliation. We have to see that the bank's book, the bank's balance, matches our balance in this reconciliation process, because there could be some differences in deposit recording. Maybe checks haven't been cashed yet and so forth. And so we have to go and verify all of this information. And again, there could be maybe the bank has paid you interest that you didn't record yet. Deposits in transit. This is where deposits are being made but haven't been maybe recorded yet. Maybe there are outstanding checks that haven't been cashed yet. There could be errors and so forth. There's some adjustments that you made and so forth. So you do need to reconcile your books with the bank's books. And there's 9 steps. I'm not going to go into great detail, but you do have to add your deposits in transit to maybe the bank statement because they haven't fully recorded that yet. Maybe you recorded checks as being paid, but they haven't cleared yet, so you have to subtract that out and so forth. And just goes through these processes. I would definitely suggest going through the book here. And this is done, like I said, every month. And then you only record those items in your adjusting entry here. Cash, collection expense, maybe there was the collection expense, maybe the bank charged you for something. Maybe here you earned interest, so you got to record that. Maybe there was a miscellaneous here that was for check printing charges that they didn't really send you a bill for and so forth. There was a non-sufficient fund. So you're going to have to, once you reconcile this, and there's going to be some adjusting entries at the end of the month, which is normal, by the way. Basic principles of cash management. Should I stop here and maybe go to another slide? Let me see what this is real quick. No, I think I can try to do this. Again, some basic principles of cash management. Again, this is a whole function of Treasury Department. This could be actually a high-paying job for big companies here. But you do want to increase the collection of your receivables. You want to manage your inventory to keep it low, just needed. Delay payments. Now, I don't mean delay to the point where you're getting penalized, but if the bill's due on the 30th, why pay on the 15th? Pay it on the 30th and earn those 15 days of interest. Plan timing of major expenditures. Often in a business there's seasonal factors, and this between the high and low might mean you might not have enough money to be able to account for that. So maybe you need to factor in a loan from the bank. Well, you don't want to go to the bank the day you need the loan. You might want to do this 3-4 months in advance and get an operating line of credit. And so you need to plan for that. And then another component is to invest idle cash, or excess cash that is sitting there. So cash budgeting is vital to a CFO or Chief Financial Officer. And again, you want to anticipate your cash flows over a 1 or 2 year period. It is an extensive part of the job here. And cash budgeting, you're accounting for cash coming in, cash going out, and there could be a financing section that you might need during your low season versus high season, so forth. So I'm not going to spend a lot of time on days collected here. It's just accounts receivable or net sales, and it is tracked a lot, especially in the retail industry. And that concludes our Chapter 8, and we'll start in later with Chapter 9. Thank you.